Why do so many ordinary people lose money trading stocks? Not because they are lazy. Many of them worked very hard. They watch the news. They follow interest rates. They study charts. They read about inflation, oil prices, wars, central banks, gold, AI stocks, and sector rotation. They collect more and more information. But information is not understanding. And a chart is not a business. This is the biggest mistake many retail traders make. They think they are investing. But most of the time, they are only guessing short-term prices. Real investing means understanding how a company makes money. Who are its customers? Does it have pricing power? Are its margins strong? Is its cash flow healthy? Can it survive competition? Does the business still matter 10 years from now? These are business questions. But short-term traders often ask different questions. Will it go up tomorrow? Is this stock about to break out? Is this sector rotating? Is this news good or bad? Can I buy today and sell higher next week? It feels intelligent, but it can be extremely dangerous because short-term prices are full of noise, emotion, liquidity, news shocks, algorithmic trading, institutional flows, market positioning. A normal person sitting in front of a phone may believe they can beat all of this with a few indicators and headlines. That belief is often the real risk. Imagine you are choosing someone to marry. Someone gives you a full report: age, height, income, education, family background, spending habits, health records, personality scores, social connections, even predictive charts and mathematical models. But there is one rule. You cannot meet them. You cannot talk to them. You cannot see how they behave under pressure. You cannot know what they are really like in daily life. Would you marry them based only on the data? Probably not, because you know that data is not the same as real understanding. But in the stock market, people forget this. They buy companies they do not understand. They have never used the product. They do not know the customers. They do not understand the cost structure. They cannot explain the business model, but they still put money in. Why? Because stocks are easy to buy. Open an app, tap a button, place an order. The action is simple, so people assume the game is simple. But the opposite is true. The easier a market is to enter, the more crowded and competitive it becomes. You are not only trading against other beginners. You are trading in a market filled with institutions, algorithms, professional analysts, and investors with better tools, better data, and more experience. This does not mean ordinary people should never invest in stocks. They absolutely can. But investing and trading are not the same game. Investing is buying a share of a business and allowing time to work. Trading is trying to predict what someone else will pay next. One requires patience and judgment. The other often becomes a mix of emotion, luck, and overconfidence. So the real question is not, can stocks make money? The real question is, are you investing? Or are you using the language of investing to gamble? If you buy a company because you understand the business, believe in its long-term value, and can survive volatility, that is investing. But if you buy because the chart looks exciting, the stock is trending, or you think you can sell to someone more optimistic tomorrow, you are not investing. You are guessing. The market does not reward you for staring at charts. It does not owe you profit because you feel informed. Sometimes the smartest financial move is not finding the next breakout stock. It is admitting what you do not understand. And in investing, the most dangerous person is not the person who knows nothing. It is the person who knows a little and thinks they understand the whole market.